Join us right now, Cole Smead, CEO and Portfolio Manager of Smead Capital Management. This is typically a light volume day ahead of the holidays, Cole, but everybody is still a little AI crazy. And I imagine there's going to be a lot of conversations about the Mag 7 and NVIDIA and stocks like that, and maybe a little Bitcoin over the Thanksgiving Day dinner table tomorrow. Where do you land on where we really are?
Yeah, happy Thanksgiving week. So, Andrew, to your point, I think a lot about the Sam Altman interview from a few weeks ago with Satya. I think that was really kind of a tipping of the scale in a way. And ever since then, things have just been different in markets and felt different. You were mentioning Andy Grove earlier. Andy Grove's best business advice he ever got, he said, was from a City College professor of his. He said that who said, if everyone knows that something is so, nobody knows nothing, okay? And I say that because I think what everyone knows is that we're going to use AI. And the problem is they don't know the cost and they don't know the future pricing. So I think a lot about like the paradigm of the oil business that we saw in the 2010s. There was tons of investment. It was very exciting. Wall Street could sell it. And the only problem was the price, as we can see today at $57 a barrel on WTI, was the unknown. And the history of technology is that the paradigm argues that cheaper prices come. I think of what a computer would have been bought in 2000 or internet, high-speed internet, beyond 56K at that point. And so I just say that because I think the market's trying to swallow that and understand that the likelihood is we've greatly overpriced this.
So if we've greatly overpriced this, what do you do? Meaning, are you not owning these stocks? And by the way, if you don't own these stocks, I'm not sure what stocks to own because I assume that it's like a domino effect if these stocks come down materially in price.
Well, I mean, to your point, it'd be like not owning RCA in 1929 or something along those lines. Here's what's interesting. Let's just say we go back to the prior technology telecom, CapEx boom. Let's say we go back to that point and say, okay, who were the players? You had Lucent, you had WorldCom, you had Nortel, you had Global Crossing. And then we know who survived, right? In many ways, we have the cable companies, but AT&T and Verizon were big survivors out of that era. And I think the only problem we draw out of it is AT&T and Verizon since 2000 has produced 5% compounded for 25 years. So one of the arguments being made, to your point, is that, oh, no, there's going to be one or two that kind of take up all the demand, winner takes all format, et cetera. And history argues that even they make mid-single digit returns. If we go to the oil business and kind of use that same paradigm, Andrew, again, you're going to find mid-single-digit returns since the peak in 2014.
Where do you put Amazon in that list then? Amazon Amazon obviously was born in the 90s, and look at it now.
Except that they didn't build the infrastructure, Andrew. So think about it like this. I was watching Eric Schmidt speak here in Phoenix last week, and think if you're Sergey Brin and you're Larry Page, you're sitting there at Stanford in '02, and you're having a cup of coffee, and you're like, isn't this incredible? We can run our algorithm on digital search in a way that's novel for its time. And the great part is they didn't have to do the CapEx to build the internet. That's the big difference. You don't want to own the people that do CapEx because the winners will be the people that didn't get it at a much cheaper price, much like the consumer did with the internet or the consumer did with oil or the companies that benefited off all those phenomena. That's the big catch. The market's pricing up the idea that the spenders on CapEx are the winners. History argues directly against that time and time again, but we have to kill this fever. And like I said, so far, it seems like Sam's interview with Satya has quelled a little bit of the fever. The question is, to your point, how swiftly does that fever get dealt with?
Okay, so then, assuming you're right, who do you like in this new universe, and who would you not touch at this moment?
It's a great question. And by the way, I'm assuming I'm right too, for better or for worse. So to your point, if you go back and look at those prior eras, you couldn't own much around it. I mean, so just use the oil thing, for example, Andrew. It didn't matter whether you owned the producers. It didn't matter whether you owned the servicers. Even the industrials in many ways got caught up in that game, in that euphoria. If you look at the telecom bust, to your point, it wasn't just the spenders that got caught up in it. It was the .coms and it was the software companies, et cetera. So you have to look weird right now. I think to make good long-term equity returns right now, you have to look pretty weird. You have to go to corners of the market that are just totally underappreciated. So, for example, what's interesting to me, you were talking about Fed policy a little bit, and we're going to see lower rates on the short end of the curve. And you can see a lot of credit sensitive parts of the stock market that people don't necessarily want to touch, even though things are getting better. So you can find, like, we own mall REITs. They're trading for implied cap rates of 7 to 8% in some cases. We're going to see a short of the curve at 3 in the not too distant future because Trump wants it there. And as we've seen with oil, if he wants it there, he's probably going to take it there. There's things like that there's real value in. But to your point, Andrew, to be a broadly diversified trillion-dollar institution, you can't do that stuff. So I think the small investor has a big edge. And I say smaller institutions, smaller investors. It is not a great time to be a big institution or a widely diversified, rich family office in the world. But then again, that's really the mean reverting factor of capitalism, and so be it.